Good afternoon, ladies and gentlemen. Welcome back to the 29th of July weekly market review. It's me again, or I should say it's us again, because I also have Mr. Gerald Wong with me today. How are you, Mr. Gerald?
Hi, we are coming to the last week of July very fast. Now going into August, I see a lot of Singapore flags being flown as we approach National Day. So at the same time, we are into the earnings season. So quite a lot of things that are happening in the markets as well.
Yes, looking forward to another holiday break, which we needed very badly. And of course, last week was another sort of a turbulent week for the market as well. And we saw the continued rotation out of the tech winners into smaller caps, into defensive name, into interest rate sensitive names. And we, like you said, we are 1/3 into the earnings season already, at least on the US side. And the earnings still is looking okay. I felt that will be a catalyst. And last Friday, we get that rebound that we badly needed because of the inflation data from the PCE index. So we'll cover some of that with us today.
Yes, so quite a lot of things to unpack given that we are in the earnings season. A number of companies reported that led to share price movements. Okay, before we start, just the usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming Ask SIAS on the 21st of August. This is free and exclusive for members of SIAS. So if you'd like to ask Sunny and I questions, do scan this QR code to register your participation. Okay, if you find our weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can scan this QR code or go to sias.org.sg/membership. And the membership will cost $12 per year or only $1 per month. Okay, so we start by going through the markets. Like we see here, the S&P 500 was down by about 1%, now close to the 5,450 levels. This was led by the decline in tech stocks, where we saw the Nasdaq down by 2.1%. And like Sunny mentioned, we are actually seeing a rotation into some of the value names, and we see that the Dow Jones was actually up, even though the S&P 500 declined by 1%. Okay, closer to home, we saw the STI declining after reaching its 6-year high earlier. We are now back to close to the 3,400 levels after a 0.6% decline last week. Okay, what was the key driver of the market? This was really driven by the US inflation data that came out. Okay, we saw that the June PCE core number rose by 2.6%. This was below the market expectations. And if you look at the trend over the past 12 months, it has been on a steady downward trend. Okay, so this actually led greater investor confidence towards a potential rate cut coming through in the coming months. Okay, this is what we see for the US government bond yields, continued decline. This is the 2-year bond yield, which is what investors typically use as an indication on what the Fed is likely to do. And what we see here is that it came down to about 4.4% last week, from actually about 4.7+% just earlier this month. Okay. If you look at the latest CME Fed Watch 2, there's now greater probability of a rate cut in September. Okay, so close to 90% probability that we will see a rate cut coming through in 2 months' time. And more importantly, if you look at the expectations for the rest of the year, investors are also expecting another rate cut in November, followed by another one in December. Okay, so all the data is driving towards greater confidence around a potential rate cut. Okay, if you look at the STI top and worst performers, if you look at the top performers, Yangtze Shipbuilding led the gainers, actually up by more than 10%. So that is something that has actually continued the momentum that we see for Yangtze Shipbuilding share price over the past few months. Okay, Seatrium, another offshore marine stock, also up by 2.7%. The company stock also saw gains today on Monday after the company announced that it is going to report a net profit for the first half of 2024. Okay. If you look at the other top gainers, we have some of the Jardine related names and Singtel, also another stock that has done very well with another 0.7% gain. Okay, in terms of the top losers, we see here a number of REITs. CapitaLand Ascendas REIT down by 1.5%, Mapletree Pan Asia Commercial Trust down by 2.3%, and Mapletree Logistics Trust down by 4.4%. Okay. Quite a number of developments around the REITs. Previously, we saw that they had a very strong bounce a few weeks ago after the greater confidence of the Fed rate cut and the decline in the bond yields. But we start to see some decline in the past week. Part of it is driven by the start of the results reporting season, where we see most of the REITs actually reporting a decline in their distributions. Okay. Last week, we also saw the MAS coming out with some proposals that will change the regulatory requirements in terms of the income coverage ratio of the REITs. So that is something that can potentially be a driver for the REIT share price once they are actually confirmed and announced. Okay, since we saw the decline in Mapletree Logistics Trust share price last week, I'll start by going through a bit more about Mapletree Logistics Trust. Okay, if you look at the share price, there was a recovery in the middle of this month when the US inflation data came out and investors began to expect more rate cuts this year. Okay, but with the latest earnings that they announced, the share price of Mapletree Logistics Trust actually came down. Okay, so what did Mapletree Logistics Trust announce? If you look at the gross revenue and net property income, they were still fairly resilient, okay, down by 0.3% and 0.9% respectively. But we saw an increase in the borrowing cost of MLT compared to the previous year. And with that, the amount that was distributable to unit holders actually came down, such that there was overall a 9% decline in its distribution per unit. Okay, we start by looking at the fundamentals of Mapletree Logistics Trust. In terms of the occupancy rate, quite stable compared to the previous quarter. It was 95.7% in the June quarter and 96% in the March quarter. Okay, so a slight decline. Where is this coming through from? Singapore, where we saw that the occupancy rate came down from 96.6% to 95.8%. Okay, so this is what we see for the occupancy rate for Mapletree Logistics Trust. We can look at the rent reversions as well. And what we see here is also some signs of moderation. If you look at the entire portfolio, the rental reversions was at 2.6% in the first quarter of fiscal year 24-25, which is the quarter ending June 2024, a slight moderation from the previous quarter. Excluding the China portfolio, the rental reversions were positive 4.6%, also a moderation from where it was in the previous quarter. Okay, next we look at the balance sheet of MLT. What we see here is that the gearing ratio went up slightly from 38.9% to 39.6%. The cost of borrowing remained flat about 2.7%, and the interest coverage ratio was also flat at about 3.1 times. Okay, so overall the balance sheet still looks okay with a healthy interest coverage ratio, just that the gearing ratio is getting close to about 40%. Okay, so overall we see that for MLT at this point in time, dividend yield about 6.9%, which is above the historical average. But the investors might want to be looking out for whether the distributions might decline further, like what we saw in the most recent quarter, and whether there is any concern around the gearing level, which is reaching close to 40%. Okay, next we look at Mapletree Industrial Trust, another REIT that saw a strong rebound in the middle of this month. but then having some slight pullback in the past week. Okay, so this is the announcement by Mapletree Industrial Trust. We saw that the gross revenue and net property income increased compared to the previous year. And the distribution per unit increased compared to the previous year as well as compared to the previous quarter. Okay, so this is in contrast to Mapletree Logistics Trust, where we saw the decline in their DPU. For Mint, actually, the distributions increased both compared to the previous year as well as the previous quarter. Okay, if you look at the occupancy for Mint, overall, if you look at the portfolio, there was a slight improvement to 91.9% compared to 91.4% in the previous quarter. Okay, so once again, this is in contrast to MLT, where we saw the slight decrease in occupancy. But for Mapletree Industrial Trust, the occupancy actually went up. Okay, most of this is driven by the North American portfolio, where we see that the occupancy went up to 87.8% from 86.2% in the previous quarter. Okay, if you look at the gross rental rate, what we see here is that Mapletree Industrial Trust appears to be signing the new leases at a higher rate compared to where its previous leases were. So that may be seen as another encouraging sign. Okay, if we were to look at the balance sheet of Mapletree Industrial Trust, slight increase in the leverage ratio to 39.1% from 38.7% in the at 31st March 2024. The weighted average cost of borrowing is at about 3.2%, slight increase from the previous quarter. But the interest coverage ratio is very strong at 4.7 times, an increase from 4.6 times in the previous quarter. Okay, if you look at the dividend yield for Mapletree Industrial Trust now at about 5.7%, which is once again above the historical average. Okay, last but not least, we come to another industrial REIT, Keppel DC REIT. Similar to what we saw for MLT and Mapletree Industrial Trust share price, the bounce in the middle of this month, followed by a slight pullback. Okay, for Keppel DC REIT, the numbers are a bit more mixed. We see here that they were able to grow their gross revenue and net property income in the first half of 2024. Okay, this is driven by the strong occupancy rate as well as some positive rental reversions. The finance cost actually went up compared to the previous year, though it was about flat compared to the previous quarter. So with these changes, they were able to report an increase in the DPU compared to the previous quarter, but it was still down 9.9% compared to the previous year. Okay, if you look at the balance sheet of Keppel DC REIT, the gearing ratio came down to about 35.8%, down 180 basis points compared to the 31st of March 2024. Okay, and the interest coverage ratio was actually fairly healthy at 5.1 times. Okay, so while Keppel DC REIT's gearing is low at the end of June 2024, they recently announced the acquisition of a data center in Tokyo. This will mark their maiden foray into Japan, which is the second largest data center hub in Asia. And what they believe this will do is to enhance the portfolio metrics as well as help to make the income more resilient. Okay, the transaction is also expected to be accretive to their DPU by about 1.1%. Okay, if you look at Keppel DC REIT's dividend yield now at about 4.7%, which is in line with its historical average. Okay, so I've gone through quite a number of REITs. We still have more REITs that are reporting this week. We've got CapitaLand Ascendas REIT, Mapletree Pan Asia Commercial Trust. So quite a number of REIT results that we'll continue to keep a lookout for. At the same time, we have other Singapore blue chip companies reporting as well, including SIA, UOB, as well as OCBC. Okay, in the US market, we have Meta actually reporting the earnings, Microsoft as well. So those are the things that I'll keep a lookout for to understand what are the latest trends in the market. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Let me share my screen first. Okay, thanks Gerald for giving us an update on how the REITs are doing. So STI opened today in the green. Now it's closer to 10 a.m. It's about up 0.58% as you can see over here. But in the morning, it did get up to a very roaring start. We are up about 0.9, close to 1%, hitting a high of 3,460 points on the STI index. Let's look at some of the counters that are pushing the STI higher today, this morning. You can see that Citrum with the news last week of the 180 million orders so far they have is up about 8% right now. That is pushing the index up higher. ThaiBev, of course, the news that we covered last week on Weekly Market Review, also up 2%. And of course, some of the REITs names that we see here could be due to the MAS proposed change in regulations that help the leverage of the REITs. That is also giving a lift to the market right now. Okay, so let's move back to the charts and see how STI is doing. So the STI index, as you can see, last week on about Thursday or Friday, Thursday it would be, we touched the 20 days moving average and then we see a bounce today. So I don't think it's a coincidence. I think it's a technical analysis 101 kind of things. 20 days moving average, always a very key number of a moving average that we look at. So once it hit 20 days moving average, definitely there will be some support coming in. So we definitely see some kind of bounce over here. But according to the indicators, the MACD is still negative. But then you can see that the gap or the magnitude of the retracement downwards from the high that we saw on the 15th of July is starting to, the downtrend momentum is starting to get weaker. And that means that the low might be in, and then we might go into a range-bound kind of a formation going to the STI index towards the next few weeks or next few months. The next support level would definitely be the 50 days moving average, which is also now coinciding with the lower bound of the Bollinger Band, and that is around the 3,380 points level. On the RSI, the latest reading this morning on 29 July is at 56 points. It is below the 66 14 days RSI moving average and also below the 70 point overbought mark. We are also a healthy range of about 6 points above the 50-point neutral mark. So there is a bit of a uptrend momentum reading from the RSI indicator. But whether this will be another leg up, that is, we are waiting for confirmation from the indicators as well. So for now, I would say maybe we have touched a consolidation phase for the Straits Times Index to consolidate, similar to the period that we observed during the May and June period, where you can see it goes into a range-bound kind of formation before starting to break out. So the range that we are looking at right now on the high side definitely is the 6-year high. That is around the level of 3,509 points, with the low coming in around last week, Friday, and that is around the low of about 3,416 points. So if we just round it off to some of the round numbers, 3,400 to 3,500 points, this 100-point range will definitely be the range that STI will likely be trending in. And once it hits the closer to the 3,400 points, that could be the point that we could be sort of a neighboring or even starting to accumulate on the STI again. Okay, so next, let's move to the US indices. Okay, so this is the Dow Jones Index. So a bit of a rotation out of the tech in the US markets right now. That's continuing for the second week already. But you can see that Dow Jones Index could be one of the beneficiary with the names that they have in the 30 stocks index. So we see a very big rebound, a 1.64% rebound on Friday, and that is a 654 points move. If you look at the other US indices on Friday, they are also up more than 1%. So the PCE data really give the market a kickstart back to a rebound, which is much needed because we have been sort of in a very turbulent kind of situation, a lot of volatility right now. So that's bringing us some stability back to the market. So you can see that Dow Jones Index also bounced on the 20 days moving average right now, and then that rebound on Friday is definitely convincing that probably this rebound, this level at the 20 days moving average around the level of 39,944 points, or the 40,000 handle that we are all looking at, that's a psychological level, would be a very strong support level to look at. That also coincides, you can see over here, with the previous double top formation in the May period as well as the March period. So this double top formation is a resistance, is a sort of a negative kind of a formation that market is going down. But then once we have a convincing break above this level, it could have a change in polarity to become the new support level going forward, coinciding with the 20 days moving average. That could have a lot of technical traders looking at this level to get back in on the Dow Jones Index. On the indicator wise, MACD indicator is slightly negative. So looking at the trajectory of the MACD line, it is not giving us any kind of an indication whether it is going to likely have a breakout up above. But likely this kind of formation on the MACD, where both the MACD and the signal line are above the zero baseline, and there is no no angle of attack, I would say, over here. That means we are likely going into a range bound kind of situation. So the formation of a range bound with the upper bound will likely be the high that we observe on 18th of July, and that is at 41,376 points. And then the low, of course, the 20 days moving average will give you a guidance, and that is around the 39,944 points. So 40,000 handle is the accumulation mark that a lot of traders are looking at right now for the Dow Jones Index. Next, let's move to the broader index, S&P 500. So S&P 500 being the broader index, slightly more volatility than the Dow Jones Index, the 30 stocks down. So we also had a bounce, not on the 20 days moving average, but on the blue line that you see here. And that is the exponential 50 days moving average of the S&P 500 index. And we also had a bounce over there. So if I'm going to scroll back a little bit, if I'm connecting the low of 2023 last year in October, as well as the low of April this year, and I draw a green color line, and that to me, that is my sort of my signal as a uptrend support line. You can see that once we hit this green line over here, we do have a support coming in as well, and that coincides with the 50 days moving average, and then we had the bounce on Friday. So that is the support that we are looking at for the S&P 500 index. Okay, the next support level will definitely, some of you will be looking at the high in May as well, and that is around the 5,350 points level. That will also lend support to the current level that we are looking at, which is very close. The last closing was at 5,459 points, and the next level could be the high on 23rd May, and that's around the 5,350 level. Okay, indicator-wise, MACD still looking not very pretty, right? Quite negative, although we have that sort of that weakening of the momentum, the negative downtrend momentum on Friday. But then you can see that the trajectory of the S&P 500 still do not look that good. On the RSI, we also have a slight downward since we hit the high on 16th of July. And then now we have a reading of 46 points, which is below the 50-point neutral mark. So also not having a lot of confidence or momentum in the S&P 500 as was indicated on the RSI until at least we hit above the 50-point neutral mark. So I would say that we are not going for a quick rebound over here. We could slightly be in a range-bound formation for the S&P 500 as well as we go into the second two-thirds of the earnings season in the US. So support level we are looking at definitely is the 50 days moving average, 5,433 points, with the next support level around the 5,300 points, which is the 100 days moving average, the amber line that you see over here. Lastly, let's move to the tech-heavy NASDAQ Composite Index. Okay, so NASDAQ tech-heavy names. Okay, so that's why there is more retracement, more volatility. We are likely going to test the 100 days moving average, which is the amber line now at 16,900, or we call it the 17,000 handle. Last Friday closing at 17,350 points is also about 300 points away from that level. So that could be the level that we are, the first level of support that traders are looking at. And that coincides with the high that we observed in 28 May as well, around its level of 17,000, the handle. That could be the level that we are looking at. So the MACD indicator was looking very negative here compared to the other two US index. And MACD has also reached below the zero baseline on the MACD indicator. So there could be more volatility and also a bit more downside risk to come, meaning that I foresee it will definitely retest the 17,000 handle or even the 100 days moving average, which is the amber line that you see here at 16,900 points. The RSI is also not looking very pretty. The current reading at 40 points is also 10 points below the 50-point neutral mark. So telling us that momentum is very weak right now. So for me, there is no need to get back immediately right now. Of course, we can start to average down from here and try to get our average price, if let's say we are going for a long position, closer to the 100 days moving average around the 17,000 handle or even the 16,900 points level. Okay, so these are the updates that I have for you on the charts this week. Anything else to add, Gerald?
So thanks for sharing the technical analysis. I guess going to the earnings season, quite a number of things that we are actually looking out for. So as we go through the next week's weekly market review, hope to be able to share some of this latest company earnings with all our viewers here today.
Yes, definitely. We will look forward to Gerald's update to give us more insights on the market as always. And I think this is the time that we have for this week's weekly market review. We hope to see you again next week or at the same time, same place on this channel. So do look out for the next weekly market review, which is Monday 9 afternoon. So we will see you again next week. Goodbye, everyone.